think we gotta hit the recording.
Yeah, it's recording.
Oh, there we go.
She's doing that. Any other food or beverage?
Can I speak now or forget it?
Yeah, no, or feel free to head out quickly, but we're going to begin with our friends. I'll turn it up to you.
Excellent. Thanks so much, Karin and TJ. For those of you who don't know them, which I find hard to believe that anybody doesn't know them, but Karin, their bios are in this handout, but Karin, I know that it doesn't say it in your bio, but you like to introduce yourself as a recovering banker. I think you've recovered quite well. He serves on a number of boards and co-founded Fresh Tracks Capital, which is one of our partner VC companies in the SSBCI funds, as well as a number of other funds and some storied Vermont names on their start at Fresh Tracks. And TJ Whalen, general partner and managing director as well. TJ has numerous experience throughout the Keurig Green Mountain history as chief strategy officer. And I've asked him to come here to talk about the opportunity that exists right now in Vermont with some of these earlier stage companies and their their corresponding need for non-dilutive capital. And so they put together an excellent presentation, and I'll let you take it away.
Great, thanks, Joan. So first, thanks for having us. We're excited to talk to you about this opportunity. Logistically, is someone going to advance the slides or?
Yes.
That's
Yelling.
Okay, great. If we could click over to the next slide. So we'll have this conversation in a few parts, and we've got, I think, maybe about a dozen slides. And I think, Joan, you had allotted 45 minutes. So I think that's more than enough time to have a conversation about this. So feel free to pause us and ask any questions along the way. And we're going to talk first, just to ground you on kind of what Fresh Tracks does and how that relates to VEDA. And then we'll talk a little bit broadly about the portfolio dynamics within a venture portfolio and how that relates to the underlying company assets, because that's going to intersect with the opportunity that we talk about in terms of non-dilutive funding for some of those companies and why that's a need. And then we'll kind of close out on some ideas or thoughts in terms of how VEDA could possibly participate in this. Okay. Thanks. So in a nutshell, we use venture capital to try to drive positive economic, community, and social development. We've been doing it for 25 years. We focus on Vermont's entrepreneurial strengths and try to accelerate the competency and capability building in areas where we think Vermont can be successful. VEDA, as you probably know, is the cornerstone LP in our newest fund. That's our sixth fund. It's a $19 million fund, and VEDA is half of the committed capital in that through the SSBCI program. And our goal, as I think yours is as well, of building great companies with value-added involvement. And Karin, my third partner, Lee, and I try to lean in as much as we can to work with these companies because we've got the benefit of some pattern recognition and quite a bit of operating history, both as investors and operators. As I mentioned, we're on our sixth fund, $75 million of committed capital. We've financed the growth of over 50 Vermont-based companies. That's catalyzed over $500 million in co-investment. We never want to be the only equity investor in a company. And so oftentimes when we lead a round of financing for these companies, we're bringing in additional investors with us. And we'll talk a little bit about the capital leverage ratio that we try to hit within the SSBCI program in a moment. Our portfolio companies collectively generate about $500 million in annualized revenue. Through this work, we've created, by our calculation, somewhere around 2,500 or so good paying jobs. We're a net importer of talent, working age tax paying talent into our state, which is not unimportant these days. And we've built dozens and dozens of high functioning teams that then kind of work in these companies. And in many cases, companies have a successful exit or they move on and do other things. And so we think we're an intellectual capital generator as well. We'll give you a little bit of a status update on the SSBCI fund. So we launched that fund in late 2023. We've called down almost half of that capital to date. That put us into 16 companies in the first 3 years. We've gone on to make subsequent follow-on investments in 7 of those. We've had 2 early exits already, which is a little unusual. That's a little early, and you're going to see in a moment how that relates to the rest of venture funds of a similar vintage. And we're tracking at or above all of the targeted metrics for the SSBCI fund. That co-investment kind of capital leverage ratio that we're striving to hit is 10x. We're currently at about a 13.5x on that. About a third of the businesses are less than 10 employees. About 16% of them are self-identified as led by individuals or owners that believe they fit the qualification of a socially or economically disadvantaged individual. 90% of them are Vermont-based companies. The remaining 10% of them have a business nexus here in the state, and that's part of when we do a non-Vermont investment out of the SSBCI fund. We need to make a case that it creates material benefit back to the state, and that includes a nexus of key management here and some element of kind of the multiplier effect that comes with that company being based here. And then there's an investment pace that we're trying to hit that was important, at least at the inception of the fund, that unlocked some additional SSBCI funds. And so we're tracking at about 134% of that. I won't go through all of this, but we've deployed about 7.5 of that 8.5 million. That's valued at about 8.5 million now as a result of these 2 positive exits there. And so if you click into the next slide, you'll see kind of how that relates to all venture funds of a similar size, of a similar vintage. And venture funds, as you probably all know, run on 10 to 12-year cycles. There are some macro factors that tend to influence how venture funds collectively perform based on macroeconomic conditions at the time of their investment period. The net IRR for the Green Mountain Fund is right about at the 50th percentile. The total value to paid in capital, that's how the portfolio is valued relative to the money that went into it, is around the 50th percentile, a little bit ahead of that. And then the distributed to paid in capital is quite a bit ahead. It's in the 90th percentile, actually a little ahead of that as a result of those 2 early exits. But if you click to the next slide, oh, there you go. This is in general how almost all venture and private equity funds work, in particular for venture funds. There's an investment period, and then you're working with these companies, and then you're harvesting value. Almost always, and it's called the J curve because it has this particular shape, almost always your IRR is negative in the first 3, 4, 5 years of the fund because those companies have not yet had time to accrete value. Right, so we're putting money in. They're almost always in a need for money, which is to say they're almost always cash flow negative. And so we need to work with those companies to get them to be more productive, to get to a point where they're building value, and then we can exit those companies when the time is right. The reason that venture funds look like this, back to the next slide, is because the early stage companies look like this, right? So the role of venture capital in general is to help these companies move from kind of a concept or an idea through product development, operational rollout, growth, expansion, et cetera. The cash flow is obviously negative in that investment period. That's why they need equity capital to be able to do that. In many cases, you'll hear about companies bootstrapping and kind of paying their own way in those early days. That generally means they're not able to hire the right kind of talent or the experience base that probably knows how to get them to those higher levels of productivity. And so for companies that have growth aspirations and scale aspirations, they're typically needing to invest ahead of their ability to generate revenue or profit.
And would you say that the need for debt is right in that middle, that development phase?
Very much so. Obviously this kind of the 0 to 1 phase is quite risky. And in many cases, the outcomes are binary. Either they figure it out or they don't. Either the product they were working to develop works or it doesn't. They either found product market fit or they didn't. We venture funds have the appetite for risk for that because we benefit disproportionately from the positive outcomes. As it relates to lending, it's probably more appropriate to be a bit more in the middle, and we're going to talk in a second about what that looks like. So I know there's different views on how well equity and debt play together. In our view, once a company begins to hit its stride and start to make investments in team, in facilities, in equipment, those things are really important investments to make. Some of those things are highly scalable. So talent, for example, or developing a new product, the return you can get as a company operator on those activities is orders of magnitude versus a piece of equipment or some other kind of hard asset that's just not quite as expandable, or inventory. And those things really are best addressed through debt because otherwise they're using more dilutive equity capital. And so when a company can bring some debt into their equation, they're minimizing the dilution of ownership. So that's better for the founders, that's better for all the employees. It allows for liquidity, working capital, inventory financing, equipment, facilities. Allows, as I said, the equity capital to be spent on the higher leverage, more scalable aspects of their business, like R&D, personnel, go-to-market, marketing, et cetera. Debt can improve the company's performance by allowing it to make the right types of investments. And most of these companies are not yet profitable. And so they're not really bankable by conventional lending standards. And as many of you know, some recent changes in March to the SBA lending requirements that basically require all tiers of ownership and all components of the ownership stack, including investors and investors funds and multi-member LLC investors in those funds. And so for someone like Fresh Tracks, we have an operating agreement with our limited partners, with our investors, that preclude us from sharing their passport or their social security numbers. And so this has created a real hiccup in the lending landscape for these companies because many, if not most of them, that have conventional bank financing are getting that through an SBA. See as we have an echo.
Yeah.
And so this new change is really, I think we've got a couple of companies and we're going to talk about one of them, but kind of a canary in the coal mine for basically any venture investment into early stage companies that have SBA financing are not going to really be able to refinance that. And they're not going to be able to expand that. And to the extent that there's something that moves around in the capital stack, some of that may actually need to be repaid.
So you're gonna present some that are.
We are going to talk specifically.
I imagine the entire like VC market in Vermont has portfolio companies in a similar.
Yes, this is not a fresh track specific issue. This is an early stage company issue that took some form of bank financing that was probably SBA guaranteed. And it's not a Vermont specific thing. It's an early stage company thing as it meets investor capital. And so I think there's going to be some unintended consequences of this policy that was implemented in March. As we look at our portfolio, we've got about $80 million worth of debt sitting in our portfolio in a variety of different types of vehicles, term loans, lines of credit, royalty financing, equipment, asset-based lending, fairly broad use of private credit, which, as you know, can be quite expensive. Rates can be 18% or more, plus all the various kind of origination fees, refinancing fees, expansion fee. You know, every time something changes, they're tacking on new fees. So you can be in the low 20s for private credit, which is phenomenally expensive for companies that don't have a ton of cash to begin with, right? And as I said, many of these conventional bank loans are SBA guaranteed, and the recent rule changes is really gonna tilt that. In the non-Vermont portion of our portfolio, we have another 34 million. So, you know, it's a pretty sizable debt load relative to the amount of equity financing that I shared on one of the previous.
And the 34 million is all SBA guaranteed?
The 34 on the bottom
Yeah.
is mostly private.
Oh.
The bigger numbers tend to be private. You know, if you're a company that's, you know, early stage, sub $10 million of revenue, and you've got, you know, de minimis EBITDA, and you've got, you know, $5+ million of debt, you probably had to go to the private market for that. Okay, so I think now we're going to click over and talk about some specific examples of companies and kind of what their capital stack looks like, and this is then going to relate to how might VEDA play a role in all of this.
So I'll jump in here and go over these companies. So we got three, and we've anonymized them. I think many of you maybe can figure this out, but you know, in the guise of, hey, we're gonna share this slide deck, and even though it says confidential on it, a lot of people might see it. We're trying to do this anonymously. So robotics company, we've got financial statements down here for the last several years. Those are in millions. This is a company that has grown, you know, moderately over the last number of years, but it's been around since 2006. So it's basically a 20-year-old company. And all of that J curve part was really the first 11 years. They didn't really commercialize anything until 2017. And that's when really the revenue activity of the company started. At this point, they have 84 employees across 4 US facilities. Vermont is the headquarters of the company, 25 people in Vermont. And by the way, what management tells us is that every single job that they create across the country, they post in Vermont first, with the idea that if they can find a Vermonter to fill that job. Now, some of them are sales jobs that are not going to be able to be done in Vermont. You're going to need to be within the territory, but that's another story. There's more than 50 customers of this company worldwide. They do both military and commercial. And military, for those of you who are lent into that market or invested in the market, can have lumpy revenue and somewhat unpredictable revenue. This company has not been, despite their best efforts in trying, they have not been commercially bankable. Next slide. So just continuing here, $38 million of equity capital invested since inception. Fresh Tracks is about $750,000 of that. The company is going to grow less modestly and a little more aggressively over the next this year and next year. They are forecasting coming out of that J curve and being profitable. I will tell you that just historically, military is a very difficult business to project. So we'll see if that happens. They've got $6.2 million worth of debt right now. That debt is $5 million of that is private credit on a term loan basis with an open maturity. And then they've got a $1.2 million facility from another private lender, which is on a much shorter term. And that private lender operates in a way where he will invest in the company, have a 9 to 12 month maturity on it, and then usually roll that, maybe increase it if things are going well. But it's only going to be for another 9 months or so. TJ mentioned what the rates can be on this, and that these rates fall in that kind of mid to high teen level. So reasonably large credit facility at reasonably high prices, totally private. Next slide. Switch gears a little bit. Software industry, asset light, but can be very valuable. Super high gross margins, very proprietary source code, all of those wonderful things. Here's a B2B software company. It's a business intelligence platform that brings some of the social features those of you that are familiar with social media might use on a daily basis, but in a business enterprise environment. Has an industry concentration or customer concentration in the automotive industry. So there's definitely customer concentration issues here. This company is growing modestly. These are also in billions of dollars. There's been a couple of years of big losses, and then last year the company made money for the first time. Interestingly enough, this company does have a bank loan from a national bank with a Vermont presence, a $3 million bank loan structured as a line of credit with an SBA guarantee. Prior to March, this company was approved for a $2 million increase from the bank in that line of credit. So the line of credit would go to $5 million. And then the SBA changed the rules. They are investor backed. We're not the only fund involved in this. So suddenly there was a problem when the bank went out and said, gee, would it be okay if you get all the passport information and or proof of citizenship from every one of your indirect owners, including our limited partners? And we obviously said no. I will also tell you that the bank said, oh, here's an idea. Just give us one social security number. I said, I think that you're asking us to commit bank fraud.
That sounded.
Those of you that are bankers know why I did the next thing. TJ was horrified. I actually wrote that back in an email with very strong language, knowing the compliance software at the bank would flag that, and somebody would be like, whoa, what the hell are these guys doing? But I mean, that's the kind of stuff that's going on out there in the market to try to get things figured out. This is a problem for this company right now. They had what they thought was a bankable company, really wasn't bankable, but they shoehorned it in with SBA. And now you're all investors kind of scrambling, trying to figure out how to handle this. Next slide.
What is the need? Sorry, what is the amount of the need?
5 million line of
5 million line.
But they're probably gonna need at a minimum the 3 million, because that's the line, so it comes up for renewal. So it's a renewal with an increase,
Yeah,
but the renewal will require the new
same thing.
information gathering, which it's not gonna get. This is a this is a very different company, consumer product company. It's actually one of Vermont's fastest growing companies. Founded in 2016, 45 people. It's now doing $80 million a year in revenue. It's slightly profitable for that level. This is a company that, if you look at the J curve that TJ was describing, the use of cash for this company and the reason it was unprofitable so long was the inventory load into retail sales more recently, and then just the inventory build required to stay ahead of $80 million worth of sales in a 10-year time period. There is no conventional financing available for this. It's just non-bankable because it lost money for the first 9 years of its existence. And we and other investors financed that over those years. There is a private lender, an actual institutional lender here called Trinity, that lends into this industry and lends against inventory, that has $20 million line of credit. That didn't start out as a $20 million line of credit. The company was much smaller when they started with them, and Trinity has grown. You said something the other day, TJ, about that.
That comes up for renewal in September.
Yeah. So, another one of those situations. These are big. I'm showing you some examples that are big, but we've got to remember that all of those examples started, this company's first loan was probably in the $2 million range at the beginning, and then it's grown. The credit facility's grown with it. So there's really some opportunities here. If we go to the next slide, I'll try to outline these. So just first of all, just some conclusions. And I don't think this is, for those of you in the credit arena, this is not surprising to you. Early stage companies can't obtain conventional financing for a variety of reasons. Early in the company life cycle, most conventional lenders want multiple years of financial statements. Most lenders want stability and predictability and incremental growth, not extreme growth. There's usually historical or projected losses, or both, in early stage companies. High revenue growth rates. We don't invest in something unless we believe at some point it's going to hit an inflection point and have a very high growth rate. Or unpredictable revenue cycles. This SBA thing threw us all for a loop. That's definitely going to be a reason going forward. Collateral shortfalls, and in many cases, collateral is a bit of a loose term for some of what's here. We look at it and think, yeah, there's some real assets there, but banks don't think of source code and software necessarily as being particularly valuable. And then customer concentration. Very often, an early stage company starts out, lands one big customer, it's half of their business, and so for some time period, they're trying to dig out of that hole and diversify. Where could VEDA play a role? Final slide. I think there's a handful of potential ways to think about this. One is the way a private lender would think about this as something akin to, or what's called, a venture debt. And venture debt is really a time note, not a term loan with regular payments, but a time note with a maturity date, a year, 2 years out, something like that. It's generally unsecured or very partially secured at best. And really what you're underwriting on in that situation is the ability of the borrower, your estimation of the ability of the borrower to raise further capital. doesn't matter what's happened in the past, does matter a lot what's going to happen in the future. And you as the underwriter have to figure out, is this team credible? Are they making progress? Are there investors out there that will invest money in this company in the future? Because that's what's going to take to keep it going. So you got to kind of know your investor rather than know your borrower, more so. Generally, these are something like a venture lender lends up to a third of what the most recent investment round was. So if the recent investment round was $3 million, the venture lender might have a $1 million time note. And the whole purpose of this is just to extend the company's runway for a period of time to allow it more time to be able to achieve certain milestones, and also time to be able to go out and raise a new round of capital. And these are generally, like venture debt today is generally underwritten with some sort of a facility fee, probably a point or two. And then probably these days, at least a 15% interest rate. At least that's the one you priced the other day, I think came in at like 15%. So that's one possibility. The other possibility is something that, when I started in the venture industry in the 1990s, I was part of an organization that was a mezzanine lender. And mezzanine lending has kind of hasn't really fallen out of favor, but it's a more structured product, and there's just not that much of it available in the entire country, let alone. Fun historical fact, Charlie Kirker, my co-founder, and I, 25 years ago, sat down with Joe Bradley and Steve Greenfield and tried to get them to start a mezzanine debt fund inside of VEDA at that time period. So 25 years later, I got a long-term vision. They didn't listen to me then. Hopefully, you don't listen to me now. I'm 25 years older. I know more than I did then. But what's mezzanine debt? Mezzanine debt is really a subordinated junior debt position that's generally always subordinated to there's almost always a senior bank facility in place in those kinds of products. Not always, but almost always. It can be unsecured or partially secured. It could be guaranteed or not guaranteed. And the whole purpose of the mezzanine debt loan is to act as a bridge till the company either reaches bankability again, because maybe it was bankable when it was a small startup business, but the high growth rate has made it less bankable. And the bank doesn't want to finance the high growth rate. So the mezzanine debt entity steps in to finance that on a subordinated basis. So it's really a bridge loan, but not a bridge loan where you know what the other side of the river looks like, a bridge loan where it's a little foggy out there and you're trying to figure out what to do. I mean, that's what you're doing. The way those are structured are generally something like it's a 5-year loan. The first 2 years are paid in kind interest, meaning you're just accruing interest and the loan's growing. And then they start on an amortization schedule, but they're on a 10-year maybe or 15-year amortization schedule, but with a 5-year or three additional year, two additional year maturity. In this day and age, they're probably 15%. They almost always have warrants attached to them for the upside, and there's almost always some sort of facility fee. So that would be another possibility. The third would be revenue-based financing. And for those of you that know anything about Sustainable Jobs Fund, that's something that the Flex Capital Fund has done for years, but in very select industries. And we would argue in industries that they have been serving have honestly too small a gross margin to really be doing revenue-based funding. But if you open up that industry aperture, to some extent, you've got a lot of higher margin industries that could use some sort of revenue-based financing. And that exists in Vermont only today from out-of-state lenders, with the exception of FlexCap, but they have a very, like I said, very narrow focus. So I think that's another possibility. And I think the final bullet point here is really, if you contemplate as part of the structure being able to take a warrant position, and a warrant is like an option on the future purchase of common stock in the company at a strike price, that's negotiated between the lender and the company. If you contemplate that, I think that gives you a bit of a sweetener on top of the high interest rates and so forth. This is, I don't know what the loss ratio is inside of VEDA right now, but I'm assuming it's reasonably small.
That's
But it has to be because the interest rates you're charging today are 6%, 8%, something like that, right?
67.
You could easily absorb, if you double your interest rates and you do that, you can easily absorb double the loss ratio. And you will expect in mezzanine finance to have a higher loss ratio. There's no way around that. But you're offsetting that with the higher interest rates and with the warrants for the handful of winners that you would end up with over time. So I'll stop there. TJ and I are happy to answer any.
So even though it's called lending, it really is more like you have an eye as if you're an investor, you the lender.
I think of it
You're
as a
certainly
hybrid.
more concerned with the ultimate
Yeah.
outcome of
Yeah,
the
like-
company's success.
Right, like, because even how to assess when their next offering would be. How would you, as a lender, know that, or even assume that? And then I'm thinking about, what about board? Probably need not a seat on the board, but at least audit the board. Activity of the.
We call those,
Observer, thank you, yeah, something like that. Like,
observation.
just trying to figure out, like, if we were to go into this field, what types of resources we would need in order to look at this in the right way, because it's not really lending, if that makes sense. It's really more like you're investing with the same type of idea that there's gonna be some losses. What is an acceptable amount, if we could even use that term? And how do you balance out a portfolio of this type of debt? I'm thinking it's more of an equity view.
Yeah, to some extent, I will say within our portfolio, I don't think any of the private creditors have board seats related to their lending activity. There is some overlap because in some cases, companies' board members are the source of that private credit. So one of those companies in there has 3 different board members who have lent the company $5 million each.
Right. Yeah, I mean, and just, I guess so in some of these cases where they can't get the renewal, a lot of the investors will probably end up lending. Is that a true, I'm just surmising here, like, is that a true story? Because like you still have faith in the company, and if they need the debt and they can't get it elsewhere, or they go to a community or something, some of the investors would end up.
I mean, if an investor, like looking at it from our point of view, if we've got the choice of lending the company money and getting repaid versus buying equity, we want to buy equity because it gives us more upside. So lenders, not always, but many times, oh, you need an extra $3 million or whatever, great. We'll reopen the offering that just completed a year ago. We'll buy more equity as opposed to lending. I mean, that's the way we think about it. Are there times when we use what's called convertible debt, which is essentially an equity instrument rather than debt instrument, just called debt? It's a bridge loan expected to convert into equity. We might use that, but that's still equity from our point of view.
Right.
It's not something they're not going to pay us back on that. We're going to get repaid through the conversion of that into stock and the conversion of stock in a sale or some other liquidity event.
Other questions?
Yes.
So what kind of monitoring do you do as a kind of equity investor? And also if you lend it to like large dollar amounts to the company, is it really like asset based? Do you look at that very closely, like an asset based lending type of a situation like the traditional?
We don't look at the, so, you know, one thing about being a recovering banker is that I understand a balance sheet where the average venture investor just less understand. There's a balance sheet, we don't need that. You need a cash flow projection, that's what matters. You know, what we generally look at is financial projections and some sort of pitch deck or so forth. We drill into that information And then if the company has historical financial statements, we'll certainly look at those. On an ongoing basis, we ask for and usually receive what's called a management rights letter, which is not what it sounds like. Management rights letter just means we can ask the company for virtually anything in the future and they will provide it to us. And in general, they're supposed to provide us, if we're not on the board, they're supposed to, with a management rights letter, provide us with all board materials as they go out to the board. They would send us a copy of those. I think in the lending world, what I saw with mezzanine debt fund I was involved in was observation rights rather than board seats, because the board seat would trigger lender liability kinds of issues.
But we always get quarterly financials, and then as companies approach key risk moments, either because they're growing aggressively or because they're coming up to something or they're in trouble, sometimes we'll tighten the cadence on that and require monthly financials from them.
You happen to know, or is there data out there for what loss rates are for SBA loans to investor-backed companies?
Specifically SBA or any kind?
Yeah, I'm just thinking SBA, like if there was a scenario where VEDA was stepping into where SBA worked before, but is now no longer working, we're filling that gap, would we be able to get some flavor on what SBA default rates have been in that niche category?
I don't, that probably exists inside the SBA. I can't imagine where you'd go to, like ask Adam Lockman or, like somebody if they have that. I don't know that they.
I don't think they're that public. Are they?
I have no idea, that's why I'm
Yeah.
asking.
It's about a private.
Right, but they wouldn't give you the specific companies, but they
Right.
might have, I mean, you obviously must have information on.
They have
So
General.
General loss.
general wouldn't be as useful
Right.
versus this
Yeah.
niche.
It would be all small business
Yeah.
and there'd be some real failure there for sure.
We're so thorough.
Okay, well, thank you. If anything comes up and you want to talk more about it, know where to find us.
Yeah, I mean, where we are right now is that we had a company approach us, an early stage company approach us. I don't think the referral came in through you. I can't remember where the referral came in from. And so, they're revenue positive. They're not yet bankable. It fits the profile, and we'll wait to get information from them. And we'll see. We're kind of like gonna see what
See
comes
what
in
or
and
if we-
see how we can get comfortable. And yeah, I mean, it's a company that's poised for tremendous growth, so it looks good, but like, yeah, this is a whole new field for us. It would be, and it's just a question of how to protect VEDA. Or we set aside and act like an SBA. I don't know. We haven't decided. We're just, we wanted to see actual possible applications so that we have a real life case to work with, if that makes sense. Yeah. And hopefully they're patient with us.
I think so.
And
I just want to say thank
Might
you.
have a
and we're
choice.
patient.
Thank you for the work that you do. I recognize myself, I wouldn't be here today if it wasn't for individuals like you who do this work. And, I had 2 private investors that helped me out when I started. And I think it's, pretty instrumental when you get told you need 2 years at least of your tax returns. It's quite deflating when you go to the bank. So, yeah, thank you. It's much needed. I think if you go back and you ask entrepreneurs how they started out, there's probably a big portion that started out through something like this, or individual investors that they knew, that they had a relationship that took a chance on them.
I mean, I would make an argument that all job growth in Vermont in the last decade has been driven by investor-backed companies, and everything else is negative. That's what I believe.
Yeah.
I've not tried to
I mean,
get the data.
I think too, you find that those individuals take it really serious about paying back those initial investors, it's something that they don't take with a grain of salt.
Yeah.
So,
Well, to Karen's point, my first foray into Vermont, the reason I moved to Vermont was to be a part of Fresh Tracks Capital's first venture investment. It didn't work out for me or for Fresh Tracks, but I landed here with my family. And then following that experience went and joined Green Mountain Coffee when we were 90 million in revenue and growing less than 5%. And 14 years later, now I wasn't the only hand at the wheel, but I think I played an important role there that helped grow that company to be 5 billion in revenue. We hired 3,000 more people in Vermont than the day I arrived at that company. So there is something to be said for the role that venture lending plays in the landscape there.
well, and most times they're very humble, right? Like you don't hear about it. And so I think a lot of startups don't even know that it exists too.
I want to, on behalf of all of us, thank you, because the whole point of this is to stimulate thinking. And I mean, I've got a lot going on that I don't want to expose by asking a dumb question right now, but
I'll be around for follow-up.
but it's, from that perspective, it's been extremely helpful. Thank you.
Well, thank you all.
We're going to shift gears now in just a moment. In discussing the strategic plan.
She's giving gifts away.
Ah,
Thank you. Thank you. Thanks so much.
She has a